Yes.
Okay. So let's start. All right. So you're welcome again to another week of financial reporting. So today we are moving on from IAS 1 on PPE. Now we are moving to IAS 16 on property, plant, and equipment. What we have tried to achieve last week was that I tried to present to you the general structure and the content of a financial statement. I showed you the template of a statement of financial position, the template of a statement of profit or loss and other comprehensive income. And we also looked at a statement of changes in equity. Those were majorly the three statements we looked at last week. And we looked at a question to demonstrate how a trial balance can be used to prepare this statement. And I give you assignments that you should try the other questions. Some of you tried it, some of you did not. Those of you that tried it, good for you. It will really help you. Those of you that did not try it, you're not doing well for yourself because the exam is getting closer and this is not the time you'll be given assignments and not do it. So, and you also see it as we move on because this assignment will help you improve in your participation in classes. So let's see how it goes today. Now, so today now, we are going to be looking at IAS 16 on property, plant, and equipment. So first thing is that if you remember in IAS 1, IAS 1 said when you have an asset, that an asset can either be a current asset or a non-current asset. And IAS 1 defined a current asset majorly as an asset that is expected to be realized within 1 year. An asset that is expected to be realized within 1 year, meaning that it's an asset that you are going to make money from it within 1 year. It now said that any other assets that does not meet this definition should be classified as a non-current asset. So majorly, non-current assets, therefore, are assets that you would make money from them for many years, beyond 1 year. However, what we are looking at today, which is property, plant, and equipment, is a non-current asset. And by the end of this topic, you understand why property, plant, and equipment is a non-current asset. So what we want to cover majorly, we are going to be looking at the initial recognition of PPE. We will look at how do you measure PPE. Then we will also look at subsequent measurements. Then we will look at the recognition. And finally, we will look at disclosures. Majorly, that is what we want to look at under PPE. And the certain items that we need to know right from the beginning that are outside the scope of PPE, that are not PPE. One is biological assets, meaning assets arising as a result of agricultural activity. They are not they are not PPE because those ones are covered under another standard. So I will not be talking about that. Another one is if you have mineral reserves or mineral rights, or you have oil mining license, that is also outside the scope of IAS 16. We will not talk about that. However, there was an update to IAS 41, right, which is outside the scope of this syllabus, but they call certain type of biological assets bearer biological assets, which are assets that you use to produce inventories or agricultural products. So when you have any agricultural item that they use in producing other items, then that might be a PPE. Items like oil palms or maybe a rubber tree, like a tree that is used in producing other items, that might be, or that IFRS 41 says that those kind of assets or those type of biological assets should be classified under IAS 16. Okay, so let's move away from there. Let's even look at what we are talking about today, which is property, plants, and equipment. How did IAS 16 define property, plant, and equipment? So IAS 16 said that property, plant, and equipment are tangible assets that are held for use, in the production or supply of goods or services, or for rental to others, or for administrative purposes, and are expected to be used during more than one period. This goes to show that when we say PPE, property, plant, and equipment, one of the first important elements is that it has to be a tangible asset. And when we say tangible, it means that you should be able to see or touch the asset. That is, it must be an asset that has a physical substance. If it does not have a physical substance, then it is not PPE. So PPE are tangible assets, very important. And these tangible assets, they must be held for use, not held for sale. They must be held for use. And what are we using them for? There are three things we are using them for. One is either you are using it for production or supply of goods or services. And example of assets that you use for production or supply of goods or services will be the equipment or plant that you have in your factory, or any other machine that you use for production. Anything that you use for your production is most likely a PPE, or that you use for supply, like your delivery van that you use to supply your goods or services, is most likely going to be PPE. Those into oil and gas, this is their pipeline that they use to supply their products. It is PPE to them. Those internet service provider that usually do wired connection, like all these fiber optic internet service provider, those are fiber that they use to transfer signals or data to their clients. Is PPE. That item is PPE because it is used in supplying their goods or services, or even for rentals to others. Another use is rental. So if you have a tangible item that what you are holding it for is to rent to other people, it is likely going to be PPE, because as you are renting to other people, you are making money from it. Just think of anything that you have, and that thing, you just there, you are renting it, right? One common one is that people used to go and rent ladder. You see, the guy that has that ladder, that is renting it to everybody, that ladder to him is PPE because he's holding it for rental to others. Or there are some people that used to go and rent, sorry to say, for the ladies, wig, for example. Now, the guy or the person that has that wig renting it to other, to him in his books, is PPE. So any item or asset that the purpose of holding it is that you want to rent it to other people and be making money, that item to you is PPE. Or for administrative purposes, if you are holding an item of asset for administrative purposes, that also will be PPE. And when we say administrative purposes, we are talking about majorly these items that would make either production or supply possible, like your furniture and fittings that you have in your office, for example. Now, You are holding it for admin, for people to be able to work on. Like the air condition you have in your office, you are holding it for use for admin, like the lift within the building, like the furniture and fittings. These are for admin, like the official car you give to your core staffs. These are for administrative purposes, like the laptop they are using to work. These are admin. So all of these items, imagine in an office where there is no air condition, or in an office that they don't have tables and chairs to sit in, it will distort their operation. They won't be able to work. So these tangible assets are going to be PPE if they are holding it for use for any of these three that I've mentioned: production or supply, rentals to others, or for administrative purposes. These are most likely going to be a PPE. However, if you hold a tangible asset and you are using it for any of these three that I've mentioned, but you can only use it for 1 year or less than 1 year, then it is not a PPE. It's most likely going to be probably something you might have to expense, right? Is not PPE. It can't be PPE, because for it to be a property, plant, and equipment, you are expected to use it for more than one period. This point 2 is extremely important. You're expected to use it for more than one period. So when we talk about PPE, we are talking about a tangible asset that is held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. As a financial reporting student, it's expected that you know this definition by heart. Thinking, you need to know that PPE is a tangible asset. You need to know that it is held for use. You need to know those uses: production of, rentals to others, administrative purposes, and most importantly, you need to know that it must be held for more than 1 year. You're expected to use it for more than one period. Okay, so that's the definition of PPE. From here, we can name series of examples of PPE, but you get used to that as we move. Now, the next thing is, how do you recognize PPE in your books? Recognition of PPE. The standards say that before you can recognize any item as PPE, it must meet 2 criteria. Number 1 is that it is probable that future economic benefit associated with the asset will flow to the entity, and the cost of the asset can be measured reliably. Those are the 2 recognition criteria: future economic benefits and the assets, and the cost of the assets can be measured reliably. And when we say future economic benefits, it majorly means that you should be able to use the asset to make money. Like the money you are making from the asset must come to you. And that will only happen if you are the one that is faced with the risk and reward attributable to the assets, most likely. Then any future benefit from the asset will come to you, either production of goods or services, or either reduction in liabilities, either cash savings, either inflow of cash. Name them. Benefits. It must generate economic benefit to you. And 2 is that it must have a cost. The cost of the asset can be measured reliably. And when we say cost, we are talking about money. The money you paid for the assets, or any other consideration given to acquire the assets. That is the cost we are talking about here. So majorly, these are the 2 recognition criteria before you can incorporate an asset into your books. Okay, one thing that is not here, let me test your knowledge a bit before I continue. Who can tell me, after an asset has met these 2 recognition criteria, and you need to now then go ahead and recognize it in your books, who can tell me the 2 entries will pass? If, for example, now you actually bought the asset and paid money. Who can tell me the two entries will pass? If we don't want to talk, you can just type it. What two entries are we going to pass? What two entries are we passing? I'm waiting to know. Yes, Abiodun, thank you. He said that you debit PPE and you credit bank. That's absolutely correct. That's fantastic. Then Benibo, the same thing. Shoyinka, the same thing. Fantastic. Okay, great. So now, you know how to then recognize an item of PPE. You simply debit the assets and you credit bank. Yeah, fantastic. So if you have not paid for it, if you had probably bought it on credit, so that means instead of crediting bank, we'll probably credit other payables. Other payables. Okay, good. So now let's move forward. The next thing is, okay, now we have recognized it. Then how do you then measure it? How do you measure it? Meaning how much? So when we talk about measurements, we are talking about the first thing we have to talk about is that, okay, at the dates of the transaction, how much do you put in your books? How much do you actually put in your books? That we call initial measurement. The date you bought the asset, at the date of the transaction, how much you put in your books. IAS 16 say that an item of PPE that qualify for recognition should be initially measured at cost. So you measure it books at cost. And when we say cost, the cost of an item of PPE comprises its purchase price. If you are importing it, then you pay import duties and non-refundable purchase taxes after deducting any trade discounts and rebates. So two things we need to clarify. I think a purchase price is clear. I think that all duties should be clear to anybody. What might not be clear to somebody is non-refundable purchase taxes. So these non-refundable purchase taxes is majorly VAT. Specifically these purchase taxes is VAT. You know, when you buy goods, the seller is mandated to add VAT. But because this is an international standard, so the standard calls it purchase taxes because it's not all countries that uses VAT. It's just Nigeria we use VAT. Some other countries use sales tax. Some use purchases tax. Some use different names, consumption tax. So we in Nigeria, we use VAT. So that's why the standard just call it purchase. Okay, the VAT you pay when you purchase. So purchase taxes. Know that this is VAT. Now, the VAT they are talking about here must be non-refundable, right? Why? Because there are some VATs that are refundable. So in Nigeria, for example, now, when you buy something and they charge you VAT, in your books, you put it as an input VAT. If you are reselling that item and you also are charging VAT again, that becomes an output VAT. When you are paying to the government, what you pay is the net. Your output you have charged minus the input you have suffered. Then the balance is what you pay to the government. Invariably, the government is refunding you the input VAT you suffered. So when you pay tax on purchases, there are certain ones that becomes refundable, especially the ones where you have to resell, right? So those type of VATs, you don't capitalize them, you probably expense them. The one you capitalize here must be non-refundable. And again, since PPE are held for use, so you don't expect you're going to sell it. So we don't expect that you'd probably have to find yourself in a situation where you want to be claiming the VAT you've suffered. So you find out that in most instances, the VAT on those purchases will be capitalized because they become non-refundable. Non-refundable because you are not selling it. If you are buying it to sell it, that can't even be PPE in the first place because PPE must be held for use. Another one that I think you need to also get clearly is that discounts, specifically trade discounts and rebates. Now, Trade discounts. Please listen carefully. When we talk about a trade discount, we are talking about reduction in price you get for bulk purchase. Bulk purchase. So the supplier is giving you a reduction in price because probably you bought in bulk, or maybe the guy is just saying that, okay, he's excited that you were the first customer that came to buy from him this morning. Or maybe the guy is saying that, okay, being a first-time customer, I'm giving you this, or the guy is doing bonanza, or the guy is doing buy one, get one free, or the guy is doing promo, all those kind of reduction in prices, or he's doing Black Friday, stuff like that. Those are trade discounts that they give you immediately. That if the listed price is 10 naira, that what you pay immediately is 8 naira. Those are most likely going to be a trade discount, right? Because you get an outright reduction in price that you deduct when determining the costs because you enjoy it immediately. However, the examiner will always give you a poser, and the examiner will tell you about early settlement discount, right? When you have early settlement discounts, that you don't deduct from costs. In fact, that one is an income. If you get it, why is it an income? So when you have an early settlement discount, it works in such a way that they will tell you that you will get a reduction in price if you pay within 30 days. Majorly is a reduction in price you get for prompt payments, right? So that kind of reduction in price at the date of the transaction, this we are getting cost at the date of the transaction. We are measuring at the date of the transaction, you are not sure whether you will get it or not. You are not sure. So it's not something you get immediately. It's something you will get in the future. And that is not what we are doing here. What we are doing here is how much today. That's the initial measurement. Therefore, if that's the case, then when you have early settlement discounts, that will not be deducted from your cost. So if you're not deducting it from your cost, then how do you treat it? You see, realistically, early settlement discount, it means that if you are paying promptly, if you are supposed to pay, let's say 15 naira, at the date when you are ready to pay, you won't be paying 15 naira. The guy might give you maybe 10% discount. Then he tells you 45 naira. What has happened is not a reduction in cost, though. What has happened is a reduction in liability. Why? Because after the date of the transaction, or immediately after they have given you invoice, any amount you have not paid becomes a liability in your books, right? So if at the date you are supposed to settle, they now say, okay, don't pay this amount, pay. That is a reduction in liability. And a reduction in liability. So when you have an early settlement discount and you get it, you pay promptly, they now give you that reduction in price. It's a reduction in your liability. And that's typical discount received. That's what we call discount received. That's how you treat early settlement discount or a cash discount. You don't treat that as a reduction in your cost like we do it here, because it's not a reduction in cost. It's not something they give you immediately. It becomes a reduction in liability in the future if you pay early. It reduces your liability. So, and if you remember the definition of an income in the conceptual framework, it said income is an increase in assets, decrease in liabilities. So whenever you experience a decrease in liability, that is an income. And when you have early settlement discounts in a question where they ask you to determine the cost of an asset, they say determine cost of an asset. You now see early settlement discount. That means you ignore it. You ignore because you don't need it for that particular question. Okay? So I hope those explanations has helped your understanding. That is the first component of cost of PPE. The second component of cost of PPE is directly attributable costs of bringing the assets to the location and condition necessary for it to be capable of operating in the intended management. So the next element of cost is directly attributable costs that you incur bringing the assets to where you want to use it, in bringing it to an operating condition as you intend, right? All those costs you incur in that process should be capitalized. And example of those costs, the first one is employee benefits or staff costs that directly involve the construction or acquisition of the asset. That should be capitalized. So if you are constructing an asset yourself and some of your staff participated in the construction, the money you pay to such labor cost majorly should be added as part of the cost of the asset. Then site preparation, where you want to place the assets, if you have to get it ready, or probably you want to construct a building, you have to clear the site, do some groundwork, getting it ready. That should be capitalized as part of the cost of the asset. Initial delivery and handling, if you have to deliver the asset, whether within the country or from outside the country, that transportation cost is part of the cost of the asset, which should be capitalized. Also is handling costs. If you have to do some kind of packaging just to ensure that the asset doesn't break in transit, or probably Agbe stopped you on the way and they had to collect some money from you, or you had to pay some taxes when you were coming. Handling costs, just to ensure it gets to its destination safely, that should be capitalized. Another one is installation and assembly costs. If you have to install and assemble the assets when it gets to the location, that should be capitalized. Professional fees, if you had to incur legal fees, let's say a lawyer had to draw up a contract for you before you can start using the asset, or probably it's a building you are constructing and you have to engage the service of an architect, a structural engineer, any professional fee that you have to incur before you can start construction or before you can use the assets, these are professional fees. These should be capitalized because they are directly attributable. And finally, is cost of testing. So it requires that before you use the assets, you need to test it to know whether it's working properly. That cost of testing must be capitalized. It has to be capitalized if it requires that you have to test. However, when I say testing cost, it means probably maybe it's a plant you want to test and you have to buy some materials, pay some people that will work on it just to test it, right? All those money you incur, testing costs, capitalize it. So, it's possible that you now test a machine, then you actually now produced something, right? You test it, you bought materials, bought some things, then you now produced something and you saw that it's working properly. Those what you produce, they are samples just to see whether the asset is working properly. If you happen to now sell that sample, you now sell it, you made money from that sample. Don't recognize that as revenue or sales. Rather, you come and deduct it from this testing costs. That's why cost of testing, whether the asset is working properly, after deducting the net proceeds of sale of samples produced during testing. So after you have deducted sales or proceeds from sales of samples, then that will be the net testing cost, right? So these are directly attributable costs. I kind of asked you to mention this for 3-4 marks before now. So there's something you have to really know by heart, this particular one. So the next and final one is the initial estimates of the cost of dismantling, removing, and restoring the site on which the asset is located. This should be capitalized, okay? And this majorly is popular majorly in oil and gas, right? Where they will have heavy machine on the drilling site. And there's usually a law that says that after you are done with your drilling, make sure you remove the asset and restore the place back to, because they know that they will have spilled some oil, destroyed the land, so they need to return it back. So usually when we have that kind of situation, it is expected that you would have an idea of how much you would incur. Because what you are going to incur is not something you incur now. It's something you're going to incur in the future. In the future. And in reporting, we don't recognize future value. Accountants or financial reporters, we don't recognize future. We don't do budgets. What we recognize are fair value and historical costs. That's what is the value today. So usually, first is that we have to make an estimate, right? So when we make this estimate, what we will recognize in our books is a present value to be discounted to present value. To be discounted. So what we recognize in respect of these initial estimates of dismantling, removal, and restoration is the present value of that cost we will incur in the future, right? So because it's not something we'll incur, so that means if we are adding this cost to the cost of the asset, there must be a corresponding credit, and that will be a provision, which will be recognized in line with IAS 37. And that's what this other sentence is talking about. Provisions, it must also be recognized as a provision on the corresponding side. So this is this initial estimates. Okay, so these are the components of costs. The last time I can ask this, it was for 8 marks. So they wanted you to mention everything. They said just discuss the component of cost of an item of PPE. So you have to be very comfortable with mentioning all of these items. Now, fundamentally is this. You see, what becomes cost of an asset are the costs that gets the assets ready for use, gets the assets ready for use. So where a cost is incurred over a period, when there's a particular cost that is incurred over a period of time, as soon as the asset is ready for use, any cost incurred after the asset is ready for use should be expensed. Any cost incurred after the asset is ready for use should be expensed. And again, if when you are constructing the asset, there was some wastage material, that's you don't add it as part of the cost of the assets, that should definitely be expensed. And there is one other thing, though IAS 16 majorly mentioned this A, B, and C that I've mentioned here. However, there's something we call borrowing costs associated with financing a constructed asset, which means that if you had borrowed money from, let's say, a bank to buy or to construct an asset, this IAS 23 states that, I will still teach you, but I just want to introduce it to you because you might need it later when you are practicing some questions. IAS 23 states that the interest you are paying to the bank, interest, not the money you borrowed, though, the interest you are paying to the bank, it says you should add it as part of the cost of the assets till the date the completion is complete. Okay, so majorly this applies to if you are the one constructing the assets yourself and you have to borrow from a bank and you are paying interest. You see that interest you are paying, you should add it to your costs. I know you know that interest normally should be expensed, fine, right? So in this case now, if you are constructing the assets, you see all through the construction phase, see when the construction is ready, any interest you are paying on that borrowing, just add it to the cost of the asset. IAS 23 says that it should be capitalized. Just take that for now, that the cost you incur or the interest you incur on borrowing up to the date of when the construction is complete, those interests you are paying to the bank, you need to capitalize everything. So after the asset is complete, if you are still paying interest, then those ones should be expensed normally as finance cost. Okay, so that's just like a bonus, what this one is talking about, because we know that I just want to fast forward knowledge, but be sure that we're still going to deal with IAS 23 later on. Okay, now the next one that I need to point out for you before I move to a question is that we need to identify some of the costs that are not directly attributable. Because I've seen I can ask it before for 4 marks. I think it was last 3 diets that they asked that according to in line with IAS 16, mention 4 costs that are not directly attributable. Okay. So the standard gave us some examples that I will need you to use for your exam. One is the cost of opening a new facility or startup costs, or maybe pre-production costs. Okay. So majorly, we are saying that the asset is ready. You now want to do an opening ceremony or what Nigerian government call commissioning. That, okay, you want to commission it. Any cost like that should be expensed because they don't really make the asset ready for use. The asset is already ready. You are the one that wants to do ceremony or you want to open the facility. So when the asset is ready, any cost you are now incurring should be expensed. So cost of opening a new facility, startup cost or pre-production cost should be expensed. Another one is the cost of introducing the product. So the asset is ready. You now want to do some advertisements or promotional activities. Those ones should also be expensed. They are just advertisement costs. So you should most likely expense them. Another one is the cost of conducting a business in a new location or with a new class of customer. So these are majorly like staff training costs or relocation costs. If you have to relocate some staffs or you have to relocate the assets, those ones does not make the asset ready for use. They are just extra costs. The asset is ready. So cost of conducting a business in a new location. So, or maybe you have to train your staff to use the assets. That it should be expensed because the asset is already ready for use. It is you that don't know how to use it. So that one is a different thing entirely. What is important for IAS 16 is that, is the asset ready? If the answer is yes, any other cost incurred after then should be expensed, like staff training. The next one is administrative and other general overheads. These should also be expensed. These are things like salaries and wages, diesel, petrol, all of those administrative costs should be expensed. And finally is initial operating losses. So you have started using the asset, but you are incurring losses because the asset have not reached its peak level. Any initial operating losses should be expensed. They are not directly attributable. They don't get the assets ready for use. The asset is already ready. Just that for whatever reason you are incurring loss at the beginning of the use of the asset, then those ones should be expensed. So that is the initial costs of an item of PPE, and that's how you initially measure an item of PPE. Now let's look at this question to demonstrate our knowledge. Let's look at this question to demonstrate our knowledge. So before I proceed, do we have any questions? Hello, Kaide, you can go ahead and ask your question.
Okay, so thank you, Mr. Sorry, I don't know your name. Sorry, sorry. Thank you for the opportunity to ask. So, are you saying in real world, if a company or wants to buy a car, say 10 million, and a discount was given upfront, um, is the actual cost? I mean, is the cost is the total cost, excluding the discounts that will be considered?
Yes.
Oh, okay. Okay. So
Yes.
total cost plus the discount, right?
Not plus or minus.
Oh, minus the discount. Okay. Thank you.
Yes.
Just want to confirm that.
Okay. So we can move ahead. Now, let's look at this question. This question says that on 1st October 2006, Omega began the construction of a new factory. And as a cost relating to the factory incurred in the year ended 30th September as follows. They give us all of these items, a purchase, cost, okay, all figures are assumed correct. So they give us some notes. They now ask us to calculate the initial costs of the factory. Okay, let's look at it one by one. So since they said we should determine the cost of the new factory, so first is the purchase of land, this 10 million. Are we going to add that as part of the costs? I need you to participate now, please. Don't just hang on there.
Yes.
How to participate?
Yes.
Okay, that will be added. The next one is cost of dismantling existing structure on the sites. Will that be added?
Yes. Yes. Yes.
Okay, that's correct. The next one is purchase of materials to construct the factory. This material cost, will that be added?
Confirmed. Yes.
Good. The next one is employee benefits 1.8, but they give us a note. So we have to look at the notes. They said note 1. They said that the factory was constructed in 8 months, ended 31st March 2007. It was brought into use on June 2007. Okay. Meaning that it took them 8 months to construct the factory. So meaning the assets, the factory was already as of May 2007. But they started using it in June. They now said the employee benefit costs is till June, is for 9 months. So that means this employee benefit cost relates to 9 months. So I think they are trying to tell us something here. So meaning that, are we capitalizing the whole of this 1.8 or a portion of it? And if it's a portion, how much? So the construction itself took 8 months, but the asset was brought into use in June. The employee benefit cost they give us is for the 9 months. When did they start construction again? 1st of October. So if you count your hands from 1st of October to when the asset was completed, that would be 8 months. Then they started using it in the 9th month. And the employee benefit cost they incur this for 9 months. Okay. So how much are we capitalizing here in this
That's
employee
eight,
benefit
eight
cost?
months.
What do you say?
8 months.
That's correct. That's 8 months. Okay. So because the asset was ready for use in May, any cost incurred after the asset is ready for use should be capitalized. So though the employee benefit was incurred for 9 months, but the portion of it we're going to capitalize is the one that is directly involved in the construction, which is 8 months. So let's do 8 over 9 multiplied by 1.8. What would that give us? 8 over 9 multiplied by 1.8. All right. So the next one is production overhead directly related to the construction. They give us a note. They say that one is 1.2. Let's look at the note 2. They said that the production overhead were incurred in the 8 months ended 31st March 2007. This includes an abnormal cost of 200, which was incurred due to the need to rectify damage. So the production overhead were incurred in the 8 months. This includes abnormal costs. So what are they saying there? So this production overhead is directly related to construction, so it should be capitalized. However, there is a portion of it that is abnormal cost. Abnormal cost is wastage. Wastage. So, and I told you that if there are wastage, that should be, I told you here, where did I mention it? Yeah, initial operating, I think it was initial operating losses. So when there are wastage, that should be expensed. So the amount we're going to capitalize here is not 1,2, but 1,2 minus 200. And that's 1,000 for that, for this production overheads. The next one is allocated general overheads. General overhead, whether allocated or unallocated, general overhead should be expensed. So this 600 will not be capitalized. Next one is architect fees. Architect fees should be capitalized, yes. Next one is cost of relocating staff who will work on the new factory. Okay, let me lift this to you. So should this 300 be capitalized or expensed?
Expensed.
That's correct. That's correct. And finally is cost relating to the former opening of the facility. Expense or capitalized?
Expense.
That's correct.
Expense.
That's correct. So the final one is loan interests. Loan interests. So they gave us note 3 for that. They said that Omega Co took out a loan of 12 million on 1st October 2006. When is this 1st October? Okay, that was when they started construction. Okay, that was when they started construction. So he took out a loan on 1st of October and he's supposed to fund the construction of the factory. And the loan is 10% interest per annum. So that means that for this one, I told you about borrowing costs, that when you borrow to construct an item of PPE, the interest you pay should be capitalized up to the date of completion. So that means this interest, now if you do 10% of 12 million, that gives me the interest per annum. However, this construction only took 8 months. You started in October and we finished in May 2007, 8 months. So that means we cannot capitalize the entire 10% of 12 million. So that means we need to prorate by 8 over 12. And that's the portion we are going to capitalize for this interest. So we are not capitalizing the entire 1,2, because if you do 10% of 12 million, that gives you 1,2. This is for 1 year. The construction was completed in May. So, and that is only, it started in October, completed in May. That's like 8 months. So you need to prorate this by 8 over 12. And you got what? 800. Okay, fine. The last one here, which is note 4. This one states that the factory has an expected useful life of 20 years. At that time, the factory will be demolished and site restored to its original condition. The installation is a legal obligation that arose on signing the contract to purchase the land. The expected cost of fulfilling this obligation is 2 million. Discount rate is 8%. Discount factor is 0.215. Okay, fantastic. So this is the one I was talking about, the initial estimate of dismantling, removal, and restoring the site. That's what they are talking about here. So they are saying that the factory has a life of 20 years. And at that time, the factory will have to be demolished and they had to restore the site to its original condition. No problem. And they say that this is a legal obligation, that they already signed a contract that they have to do that. Fine. So no doubt that this cost will be capitalized. However, they said the cost of fulfilling this obligation is 2 million. This 2 million is a future cost. We don't recognize future cost in reporting. So this 2 million is not what we'll take in our books, but the present value of this 2 million. And they already told us how to determine present value, because they will give us a discount rate. This examiner is magnanimous. He gave us a discount factor. That is it. All you just need to do then is just to multiply this 0.215 multiplied by 2 million. Whatever you get to represent the present value of these 2 million. And is that you are going to capitalize and add as part of the cost of this asset. In some situation, the examiner will not give you this 0.15. You would be required to calculate it yourself, but that is a very poor way of setting a financial reporting exam. They should give you the discount factor. They should not be testing how to determine present value. No, that is not our core in reporting. That is something they should be testing in performance management, not financial reporting. So you find out that most of the recent ways ICANN are setting questions now gives you discount factor. But let's say it's still an amateur that still go ahead and set the question, and they don't give us this discount factor. How do we get it? So you probably be using PV equal to future value multiplied by 1 plus r raised to power minus n. So the way you get this 0.215, you probably be looking at something like 1 plus r, which is 8%, raised to power minus n. So raised to power minus n. So this will be something like 1.08 multiply raised to power minus 20, which is n. So all that should give us this 0.215, which you ultimately multiply by the future value so that we can get our present value. Okay, so, and this is the solution to everything I've just explained. Like the first one, we said this, and I've explained the reasons here, and you all have this note with you. So we capitalize this, the dismantling cost capitalized, material cost capitalized, employee benefits, we said that you prorate it by 8/9. Production overhead, we said that you remove the abnormal costs. That's why we are left with 1 million. We said admin should not be capitalized, it should be expensed. Architect fees, we said that should be capitalized. Relocation costs, we said that should be expensed. Cost of opening a new facility or cost of opening the factory, we said that should be expensed. Then the interests, we only capitalized the 8-month period because the construction was completed in May, so which is 8 months from 1st of October 2016. So we only capitalized 8/12 of it. If you do your math, that gives you 800. Then the restoration costs, we said this 2 million is the future value. The present value is this 0.215 multiplied by 2 million. That gives us 430. And by the time you add all this together, that would be capitalized. So any cost that is not capitalized will be expensed. All of these that we are not capitalizing, just simply take them to P&L. And that is it. And that's the end of this question. Right? If you understand this, I mean, it won't be more than this in the exam. Though we'll still solve more questions, more past questions, just to make it stick. Okay. Any questions? Any questions? Any questions? Abiodun, Kayode, Lovett, Mibat, Soyinka, Benibo. Any questions? Okay, no questions. Good. Now let's go to subsequent cost. Okay, so now we are done with initial measurements, which is how you determine the cost of an item of PPE at the date of the transaction, when you acquired it. How do you put it in your books? We are done with that. You see, when you buy an asset, you still continue to incur for that cost. And that's what we call subsequent costs. The question becomes that, are you supposed to capitalize this subsequent cost? IAS 16 says you should capitalize it if they meet these two criteria. The same criteria for recognition of PPE, that if it is probable that future economic benefits associated with the item will flow, and the cost of the item can be measured reliably, just like we mentioned in how you recognize item of PPE. If it meets that recognition criteria, then that subsequent cost should be capitalized. However, the way you will know in your exam whether it meets these two criteria, right? I think I put it somewhere here for you. Yeah. That's the way you will know is they will tell you whether that maybe they will tell you they incur the cost, and that cost improve the productive capacity of the assets, or it improve the useful life of the asset. For example, now an asset that normally produce 1 unit, if the production now increases to 1,005 because of a subsequent cost, that kind of subsequent cost should be capitalized because it has improved the productive capacity, or maybe it improved the useful life of the assets. That kind of cost should be capitalized. However, any costs that does not do this should be expensed, like day-to-day servicing of an asset or repairs and maintenance. Okay, it's just like you bought a car now, for example, and you are servicing it, or you have a generator that you're servicing. That cannot be capitalized because it's just repairs and maintenance. And when you're servicing your car the way you should, if your car is supposed to use 5 years, if you are servicing it the way you should service it, that means it will actually use the 5 years. It might not necessarily take it to 7 or 8 years. But if you don't service it, that asset will not get to that 5 years before it will pack up. So repairs and maintenance or day-to-day servicing, those ones just ensure that you maintain the productive level of the asset, or you maintain the useful life of the asset. But subsequent costs that you capitalize, don't just maintain, it improve. It either improve the productive capacity of the asset, or it improve the useful life. And in the exam, they will tell you, it will be very clear that, we incur this cost too, and it has increased the useful life by 5 years. Know that that kind of cost should be capitalized. That kind of cost should be added to the initial cost of the asset. And those are the kind of costs we are talking about. And examples of those type of costs are costs like replacement of parts. If you had to replace some parts, that should be capitalized, right? Replacement of certain major parts, okay, at regular intervals. That should be capitalized. Another one is major inspections or major repairs. That should be capitalized also. Those are the two examples of subsequent costs that you capitalize: replacement of parts, or major inspections, or major repairs. And when it comes to when it comes to replacement of parts, right? The parts that you are introducing, you add the cost to the assets. Of course, when you are replacing a part, that means you are removing something. That one that you have removed, you remove the costs from your cost of the assets. You remove it. And that is it about subsequent costs. That is it about subsequent costs. Okay, so the next one, if you don't have any question on subsequent costs, is subsequent measurements. And when we say subsequent measurements, we are talking about how to determine the value of an asset at the end of each reporting period, meaning at the end of the year. The one we looked at before, which is initial measurement, that is at the date of the transaction. Subsequent measurement is at the end of the year, at the end of each reporting period. So at the end of the year, which is subsequent measurement, the standard or IAS 16 allows for two models. One is the cost model, and the second one is the evaluation model. And when we say cost model, we are talking about cost minus accumulated depreciation minus accumulated impairment losses. See, they have asked severally that you should explain what cost model is in the exam. You don't start writing unnecessary grammar when explaining cost model. Cost model is nothing beyond your costs minus accumulated depreciation and any accumulated impairment losses. That is your cost model. So when you do this, then you'll be getting, when by the time you do your cost minus accumulated depreciation minus accumulated impairment losses, that gives you the figure you get. You call it carrying amount. That's for cost model. For evaluation model is revalued amount, meaning you are going to carry your PPE at a revalued amount. And this revalued amount is the fair value of the asset at the date of evaluation minus subsequent accumulated depreciation and any accumulated impairment losses. So cost model, evaluation model, you can't use the two, you have to choose one. And when you choose one, it's something you apply consistently. It's not something you can change, that you choose one this year. You now say you want to change it in another year. It doesn't work for subsequent cost. For this subsequent measurement, when you choose one, is that one you have to continue to use. Either you're using cost model or you are using revaluation model. And again, the model you use, you have to choose it for a class of assets, right? And when I say a class of assets, I'm talking about when you have plenty land and building. Now, land and building is a class of assets, okay? So you have to use the same model for all your class of assets, or maybe for all your land and building. For all your computer equipment, you can use another model. You can use evaluation model. But the idea is that it's on a class by class basis. Okay. You cannot say you want to use cost model for one laptop. You're not using evaluation model for another laptop. No. Class by class. So the choice is based on class of asset by class of asset. So if you use cost model for all your computer equipment, you can decide to use evaluation model for all your land and building, use another model for your office equipment. So class by class, right? Okay. So now, if you look at these two models, something is common in the two of them. We have depreciation and impairment losses. Okay. The same thing for the evaluation model too. Depreciation and impairment losses. Those two are common. So that means the next thing I want to majorly teach you under subsequent measurement is depreciation. It's common in the two. I'm not teaching you impairment losses now. I'm not even going to mention anything around it now. It's just hold that, leave that for now. When we get to IAS 36, you understand it better. So you won't find me mentioning this anytime soon until I teach you IAS 36. So let's hold that. Now we're going to go deep into depreciation, because when you can get depreciation, then apparently you will know how to determine your cost model, because you already know how to determine costs, which we did in initial measurement. So mostly by the time you do cost minus accumulated depreciation, that gives you your carrying amount. So you would already get your mark. When we learn impairment losses, then you know how to determine impairment loss. For the evaluation model, is the revalued amount or the fair value minus subsequent accumulated depreciation. Yeah, you see that in this evaluation model, when they wanted to mention the accumulated depreciation, they said subsequent accumulated depreciation. So if you are explaining this in the exam, they said explain evaluation model, you now say fair value minus accumulated depreciation. You didn't mention subsequent. You'll be wrong, because that's what distinguishes evaluation model from cost model. The fact that the accumulated depreciation is a subsequent one. So majorly, when I get to the evaluation, I'll get there today. You would learn why they put subsequent here. Again, I'm not teaching you impairment losses here in this class today. That will be taught when we get to IAS 36. Another one for this evaluation model is the fact that what we are using is fair value. I will explain that in detail when I get to evaluation. So, okay, but for now, let's understand what depreciation is for now. I know that in this class, so I'm going to depreciation. Look at the way I get to depreciation. So depreciation is still under subsequent measurement. We are just trying to determine how to determine cost model and evaluation model. Both of them have depreciation. So we want to learn how to determine this depreciation. The only reason I'm not teaching impairment losses now is because it is not in this standard. It is treated in another standard. So it doesn't make sense to start missing that with what we're talking about here. So that's why we are going to depreciation now. So now I'm sure that everybody in this class knows about depreciation, and you all have one idea or the other. But if the idea you have about depreciation is that depreciation is the loss in the value of an asset, or depreciation is the reduction in the value of an asset, please, I beg of you, perish that idea. Erase that idea from your mind. Depreciation is not reduction in the value of an asset. Depreciation is not loss in the value of an asset. It is far from it. It is so far from it. So let's erase that first. So let's start with the definition of depreciation by IAS 16. So IAS 16 said that depreciation is a systematic allocation of the depreciable amount of a non-current asset over its estimated useful life. In some texts, they will say of the cost or depreciable amount. Okay, so what does that even mean? Systematic allocation of cost or depreciable amount of a non-current asset over its estimated useful life. Looking at this definition, right, what we are trying to do is that we want to allocate the cost or depreciable amount of an asset over its life. So three things we need to understand here. One is, okay, allocation. How do you allocate systematically? What are you allocating costs or depreciable amounts? We need to know what that is. And thirdly is the estimated useful life. So I will take it one by one. I will explain depreciable amount. I would explain useful life, and finally I will explain systematic allocation, and I will be done with depreciation. So firstly, let me clear your mind around saying that depreciation provides for loss or reduction in the value of an asset. No, that is not what depreciation is. But depreciation is just an accrual and matching accounting technique that allocates the depreciable amount of the asset to the period expected to benefit from the use of the asset. So what that means is that when you incur a cost on an asset, okay, you already know that before that asset can be a PPE, it must be held for use for more than 1 year. Okay, so since this asset will be used for more than 1 year, it means that we are going to enjoy benefit on this asset for more than 1 year. We will enjoy benefits for so many years. So there's a concept in accounting called matching concept. Matching concept requires that anytime you earn revenue, right, there is a corresponding cost that helps you to earn that revenue. Match that cost. Match it in your P&L. So you are matching revenue with costs so that you can get a reasonable profit. Yeah, the same thing applies here now. What depreciation is doing for us first is that when you buy an asset that would benefit you for, let's say, 5 years. So if you use it in year 1, that means the asset has generated benefit in year 1. So you need to match that benefit with the costs, right? So which will just probably be a portion of the cost of that asset. And that portion of the cost of that asset is called depreciation, right? So all you are doing with depreciation is just taking a portion of the cost of an asset and matching it with the revenue. That's one. Two, depreciation is also to comply with accrual concept. And when we say accrual, when I taught you accrual, I told you that accrual means that you have incurred a cost or you recognize expense when you have incurred it and not when cash is paid. So in this case now, you bought an asset that is supposed to be used for 4 years, right? You have paid, you would probably pay for the assets that you want to use for 4 years. However, you cannot recognize this entire cost that you have paid in your P&L as a cost today because you have not actually used it for 4 years. So what goes in your P&L is at the end of the year, you get, okay, I've used this asset for 1 year. That means I've enjoyed benefit for 1 year. And that is what we mean by you have incurred the costs. So when we say recognize expense when you have incurred, it means that recognize an item in your as expense when you have used it, when you have enjoyed benefit from it. It's just like staying in a house, and at the end of the first month, you are supposed to pay rent, but you have not paid. Even though you have not paid, for the fact that you have used it for, you have enjoyed benefit from that place for 1 month, you still put it rent in your books. The same thing happened for an asset, right? An asset that is supposed to, you are supposed to enjoy benefit for 4 years. You cannot put the entire cost in your expense. So that's why we usually go and put it as assets. It's just we are suspending it somewhere so that periodically as we are using the assets, we'll just be taking a portion and be matching it with our income or putting it as an expense in our books. So that's accrual. So at the end of the first year, we'll have incurred a portion of the costs, incurred it, then we'll recognize that in our books and call it depreciation. So depreciation is nothing beyond a systematic allocation of that cost for depreciable amount, majorly to comply with accrual and matching concept. Depreciation does not provide for loss or reduction in the value of an asset. It's far from it. That is not what it does. In fact, that is not the core of we accountants. We are not trained. I'm not training you guys to know how to value assets or to know whether there is a reduction in the, no, that is not our strength. We are just supposed to classify and recognize costs. So if you buy items like stapler, papers, stationaries, those ones, they are always straightforward because you are going to enjoy benefit from them within 1 year. So usually we just put them as expense in our P&L. You see, those ones we capitalize as assets. We are capitalizing them as assets majorly because the benefit we enjoy from them span beyond 1 year. That's why we are putting them in our assets. Everything, what shows your performance as a business is your P&L. All those items you are putting in assets, one way or the other, they end up in your P&L, either in form of expense or income, one way or the other. In fact, it's both in most of the cases. So for PPE now, as we are using that assets, you are just recognizing a portion of the cost. So that's why even an asset that is increasing in value, we still depreciate because it's not reduction in the value. Accountant cannot know reduction in value. That is not our strength. If you want to value an asset, we usually go and call a valuer, those that are trained in that field. Ours is just to recognize how much. So today now, we are really going to learn, okay, how do you then know how much of that cost have you incurred in each year so that you can know how much depreciation you are putting in your books? So before I get there, let's start with depreciable amount. So when we say depreciable amount, I'm ignoring costs because we already know what cost is, which is that initial cost I already explained to you initially. So what we don't know now is depreciable amount. Depreciable amount of a depreciable asset is the costs or other amounts substituted for costs, which is mostly fair value, right? Is the cost minus the estimated residual value. So that is the depreciable amount. Is your cost minus your residual value. That gives us depreciable amount. So that means that there's something we call residual value that you must deduct from your cost to get your depreciable amount. So this residual value, residual value, so is like the amount an entity expects to obtain from an asset at the end of its useful life, after you have deducted cost of disposal. Because when you want to, so amount you will get at the end of its useful life is probably the scrap value or how much you can sell the assets majorly. So that has to be removed. This residual value should not be depreciated because the benefit you are getting from it is from the sale of the assets, not from the continuous use of the asset. And depreciation, what it represents is that, okay, for the fact that we have used these assets, this is the corresponding costs that we have incurred for this year. So residual value, we are not using that portion of that asset. The benefit we'll get from that portion of that asset is from selling, is a scrap value. That's why for us to get how much you actually depreciate or allocate, which is the depreciable amount, you need to first of all get any residual value and remove it. And again, residual value, like I mentioned, is the amount you expect to obtain at the end of the useful life. That is talking about future, which is uncertain. Nobody knows the future. So that's why it's usually estimates. That's why they call it estimated. So we can only make an estimate now because it's not something we can know for sure. So we just estimate the residual value for now. So that is a depreciable amount, majorly cost minus residual value. And I've tried to explain why we are removing residual value from the cost to get the depreciable amount. Then the next thing is useful life, estimated useful life. So when we say estimated useful life, so this estimated useful life, one is either the period over which the asset is expected to be used or to be put into productive use, or the number of units that can be derived from the asset. So what this sentence is telling you that don't see useful life as just period over which you are supposed to use an asset. No, it's not only that. It can also be the period over which, it can also be the number of units you can derive from the asset. So useful life can be number of years or product or the number of units. So it can also be expressed in units. You will see it. You will see questions that express useful life in units in this class. Another thing is that, again, there is no way anybody can know the useful life of an asset because this value, we need them like today. So for us to get depreciation. So there's no way we can know. We can only estimate it. So that's why they call it estimated useful life. That's why they call it estimated useful life. So the reason why I'm putting this one here is that I kind of asked this one before. How do you determine useful life? So what determines your useful life? One is the level of usage of the asset. If you can't compare somebody that has 2 cars with somebody that has 1 car. So the level at which the one that has 1 car will be using it will be very high. So the useful life of that asset will be very small. So level of usage can determine useful life. Another one is the maintenance culture. If you are servicing it regularly, then it's likely that the useful life would be higher than somebody who doesn't maintain the assets. Another one is there is a contract that places legal limits on the use of the asset. So if you buy an asset and there's a contract that says you can only use it for 4 years or for 3 years, that becomes the useful life for you because there's a contract that places legal limit on the use of the asset. If there's also a change in technology or obsolescence, that can limit the useful life of an asset. If nobody is using, people have moved on from the assets. So changes in technology can determine the useful life. Also, the quality of the asset can also determine the useful life of the asset. Another one that I can add might be the useful life of a comparable asset, the useful life of a similar asset. That can also help us determine our useful life. So if you want to determine the useful life of an asset, and there's a similar asset that used 5 years, then that can be your basis. Okay? And what I'm saying in this next paragraph is that because residual value are useful and useful life are based on estimates, so most likely they will change. It's likely, so you will find a question saying that, okay, they change the useful life, they change the residual value because you only estimated in the first place. So by the time you move through time, you could discover that your initial estimate was wrong. So you might probably have to revise it. Okay, so that's useful life. Still on the definition of PPE, the last one is systematic allocation. The last one is systematic allocation. So for systematic allocation, majorly we'll be talking about method of depreciation. So in this class, I only mentioned two because that's what the standard mentioned. The standard mentioned straight line method and reducing balance method or diminishing method. And those are the methods that will be tested in an FR exam. So if the asset generates benefits equally per annum, and most likely you are going to use a straight line method because that will give you equal amount of depreciation. But if the asset generates higher inflow at the beginning and lower at the end, then most likely you're going to use a reducing balance method. So those are scenarios where you use them. So finally is I've seen I can ask you guys that you should mention the characteristics of a depreciable asset. I've seen them ask you this before. So if they happen to ask you in the exam that you should mention the characteristics of a depreciable assets, these are the characteristics from the definition of an asset of PPE. You can get the characteristics anyways. So one is that they are expected to be used for more than 1 year. They have a limited useful life, and they are held for production or supply of goods or services, rental to others, and for administrative purposes. So these are characteristics of a depreciable assets. So finally is that how do you get reduced straight line method? The way you determine depreciation under straight line method is just to do cost minus residual value divided by the useful life. Or if they give you a percentage, just apply a percentage on the cost. But if it is reducing balance method, it's just apply the percentage on the carrying amount. And carrying amount is cost minus accumulated depreciation. Just apply the percentage on the carrying amount. You'll see it as we solve questions, but that's how you determine depreciation in each of the methods. So your exam is majorly going to be around these two methods. Finally, before we solve few questions, when does depreciation start? So depreciation starts when the asset is available for use. You start depreciation then, and depreciation would end or stop when you have sold the assets or when you have reclassified the asset as held for sale. Okay, when you have sold it or you have reclassified as held for sale. So you should stop depreciation, or where probably you're not using it again. It's just idle there. Stop depreciation at that stage. Okay, so that is it around depreciation. So let's solve few questions to understand the intricacies of depreciation. Do you have any questions? Do you have any questions? Okay. Everybody in this class seems to be very smart. Just understanding everything, sharp, sharp. Okay. So now let's look at this question. Let's look at this question. This question said that an item of plant was acquired. Hold on, please. So this question said that An item of plant was acquired for 220,000 on 1st January 2006. And they gave us that the estimated useful life of the plant was 5 years. And the estimated residual value was 20,000. All of this will have been done at the date of acquisition of this asset. We're now told that the asset is depreciated on a straight line basis. Okay, this is how they allocate the cost of the asset. We're now told that on 31st December 2006, the remaining useful life of the asset was estimated to be 3 years, with an estimated residual value of 12,000. So that means that they have changed the useful life of these assets now, because when you say that at the beginning of the year is 5 years, at the end of the year, you're not saying now it is now remaining 3 years. So that means they have seen that it cannot go for 5 years from that end year. So instead of it going for additional 4 years, they say that no, it should be 3 years now. And the residual value is 1,200. So they have changed that one too from 20 to 12,000. So you're now saying that explain how depreciation would be calculated for the plants for each year of useful life. So this question is very deliberate in terms of what they ask you to do. So you have to be very careful in the exam. If the examiner say explain and you start calculating your own, it needs an explanation. So nobody is asking you for any calculation. So just when you're explaining, you might need to put 1 or 2 figures. So let's look at the explanation here. We're told that at the date of the purchase of the assets, the depreciable amount is 200,000, which is this 220 minus 20,000, right? That's depreciable amount, cost minus residual value. That is this residual value here, 20,000. Then I said, therefore, depreciation of 40,000 will have been charged in 2006. And the carrying amount will have been 180,000. So my question is this: since you're explaining, how did they get this 40,000? They said depreciation that will have been charged in 2006 is 40,000. Who can tell us how did they get this 40,000? I intentionally did not put it because I was going to put it live in class. So how did they get this 40,000? Depreciation of 40,000. Given that, okay. Anybody?
So that will be the cost of the asset as the beginning in January 2006, which is 220,000 minus the residual value of 20,000,
Which
then
already
divided
put us
by
here, which is
yeah,
200,000. Okay. Divided by what?
and divide by 5, the estimated useful life, which is 5.
Fantastic. So 200,000 divided by what? Divided by 5
Divided
years. Okay. Fantastic. And that's Coyote, Abi.
Correct, boss.
Okay, good. So they now told us that yes, that means at the end of 2006, the carrying amount of the assets will be, carrying amount is always cost minus accumulated depreciation. So the cost of the asset is 220 minus the depreciation we charged, which is 40. Then that gives me my carrying amount at the end of 2006 to be 180,000. Good. Now, they now told us, remember, they said at the end of December, the useful life is now 3 years. The residual value is now 12,000. So given the reassessment of the useful life and residual value, the depreciable amount at the end of 2006 is now, things have changed now. There was a reassessment. So the depreciable amount will now change because we are not going to be starting from where we stopped I mean, the latest value of the asset, which is the carrying amount, 180. So, and that would be 180 minus the new residual value, which is 12,000. And that gives me depreciable amount of 168,000. So we are saying that since in 2006, the useful life has changed. The residual value has changed. That means we cannot use 40,000 depreciation anymore, right? Depreciation will change, and it will change. The depreciable amount will now be the latest value, which is 180. 180 minus 12,000, which is residual value. That give me 168,000, which will be depreciated over the remaining useful life, which is over the next 3 years. So therefore, the depreciation in 2007, 2008, and 2009 will simply be 168,000 divided by 3 years. I mean, this 168,000 divided by the remaining useful life. And that is what depreciation will be. Unless if maybe in 2008, they say, okay, the useful life has changed again. That one too, just like you have done here, you will get what is the carrying amount at that date. Get that one, just depreciate it over the remaining useful life. Like that, like that, like that. So this is a very important question that anytime I can want to ask you a question on depreciation, they will always bring in, there was a change in useful life. There was a change in residual value. Always. You just need to know that before that change, depreciation is calculated at depreciable amount over useful life. Okay. Then you get the carrying amount each year. From the date of that change, you need to know, okay, what's my carrying amount? If residual value has changed too, that's why we are removing 12,000. If residual value did not change, we won't need to consider any residual value. It will just be this 180,000 divided by the remaining useful life. But they say that residual value is now 12,000. So minus 12,000, which gives me 168,000. Divided by the remaining useful life. Divided by the remaining useful life, which gives you 56,000 depreciation every year going forward. Okay, these are our first question we are solving in this class. We are still going to solve many, many more questions. So let's leave this one at that. Another question I need to look at just to explain a concept is something called componentization. And this is a scenario where an item of PPE has different components, okay? And each component is significant, okay? And each component, most importantly, they have separate useful life, separate useful life. So in that case, you need to depreciate each component. They must be depreciated. They have to be depreciated separately. You have to depreciate it separately. So when you have an asset that has different components and each of them has different useful life, depreciate it separately. Look at what I'm saying here. Look at this example now. They said on 1st January 2002, an entity purchased a furnace for 200,000. The useful life is 10 years. But its lining needs to be replaced every 5 years. So there's another component of it called lining. And the cost of the lining is 50,000. And that is 2002. The lining was now replaced in 2007 at, that's after 5 years. Remember, they said they replace the lining every 5 years. So after 5 years, they replace the lining at the cost of 70,000. We are now asked to calculate depreciation expense relating to the furnace. Now, since this furnace has two components, the furnace and there's a lining inside. So between 2002 to 2006, the first 5 years, the assets would have two depreciable components. The first one, which is the lining component, which they told us is 50 years and is replaced every 5 years. That means this 50,000, which is the cost of the lining component, the useful life will be 5 years, since it's replaced every 5 years. And another depreciable component is the balance of the cost. If you remove 50,000 from this 200,000, then it will be left with 150,000, which will be depreciated over 10 years. That's the useful life of the balance of the cost. Knowing that depreciation, therefore, is a total of 25,000, which is the lining component, which is 50 times 1/5, or 50 divided by 5 years, plus the balance of the cost, 150,000 divided by 10 years. If you do your mathematics, you will get 25,000. Okay. At the end of the 5th year, since this one is replaced, this lining component is replaced in 5 years. So at the end of the 5th year, that would be like end of 2006. The carrying amount of the lining component is going to be 0. Because if you look at it, 50 divided by 5 is 10,000. 10 times 5 is already 50. So they will have accumulated the depreciation for 5 years. So the carrying amount is going to be 0. However, from 2007, they incurred another 70,000, which you spend another 5 years. So from the annual depreciation for the furnace will now be the 70,000, okay, multiplied by the balance of the company, which is still 150 times divided by 10 years. And that gives us 29,000. And that would be the annual depreciation for the next 5 years. Again, on these assets. So this is going to show you that, yes, when we have depreciation, a singular asset can have different components. Then you have to calculate depreciation separately on each of the components. And that's what I call the componentization. So finally for today, because this is where I will stop. Next week, I will start with evaluation. Finally for today is ledger account for depreciation. Ledger account affected by depreciation. So when you charge depreciation each year and you want to recognize it in your books, the first thing is there'll be a depreciation account, which is what goes to expense. That means you debit your P&L with a depreciation expense. And the other leg is the accumulated depreciation account, which you will use to decrease your assets. That is, you are going to credit an accumulated depreciation account. So you will see that depreciation is not something, it has nothing to do with assets directly. Depreciation, you debit depreciation account to P&L, which is an expense. And the other leg is accumulated depreciation. And the aim of this accumulated depreciation is such that you can track how much of depreciation you have charged till a particular day. So if you are charging depreciation after 5 years, for example, now if you go to your accumulated depreciation account, the balance there will show you the depreciation you have charged for over 5 years. So while this depreciation account is just for the year, is an expense. This other one, which is an accumulated depreciation, is a decrease in assets. It's usually charted to asset account, but it's something you would continue to carry forward, right? And the only place you use it is when you are doing your fixed asset schedule, when you want to get your carrying amount, because it's your carrying amount you ultimately take to your assets, to your PPE. Okay, so remember when I spoke about the cost model, we said that it's costs minus accumulated depreciation minus accumulated impairment losses. Those 3 elements in that model, they are separate accounts. So there's cost. Cost is what you find in your asset account. Your asset account will be at cost. It will be at cost. Please don't forget this I've said. Asset account is always at cost, year in, year out, year in, year out. It doesn't change. Then you have the accumulated depreciation account, which is just tracking the depreciation you have charged on these assets till date, or you're charging over time. So at a point in time, when you're carrying amounts, you just go to your asset account. You pick that one. You go to your accumulated depreciation account, which is the total depreciation you have charged to date. You go to your fixed asset schedule. You do cost minus accumulated depreciation. The carrying amount you get, you take to your statement of financial position. You will see all of this in action very soon. So this is the ledger account by depreciation. Now, there was this question they asked in November 2020. With this, what I've taught you today, you should be able to ask this question. I know the solution is there with you. I know the solution is here, but I would advise you to attempt it yourself without looking at the solution. It will greatly help you. So next week, when we resume again on Saturday, then we'll review it. And if you have any questions, if you are not clear on it, then we can discuss it. But it will even be better that you would reach out to me before next week, Saturday, so that I can explain any confusion you have. But I really need you to go and attempt this question yourself. It's very important to me that you attempt it yourself. So on these notes, we're going to end this class here today. Next week, when we resume again, we're going to be looking at revaluation. So this will take care of that revaluation model. We are still on subsequent measurements. Don't forget, we'll come into revaluation. We'll explain all of that. Then I will teach you around disposal also, which talks about the recognition. Then when we are done with that, look at disclosures. Then we'll start solving practice questions. It's not something we'll finish next week. We're still going to continue. So Akimade, I have not sent you this solution. Okay, I will send you the maps. I sent material along with the email. Okay, so Kayode, I think you have been speaking to me and Mr. Wasiu that I have been talking to. So yeah.
Oh, sorry, I didn't quite know the name. Thank you so much. I'll check
Okay.
it out. Thank you.
No problem. All right, class. Any questions? If there are no questions, that means we'll continue next week. Any questions? Okay, no questions. All right, thank you very much and have a wonderful evening. Bye-bye.
Thank you, and you too. Bye.
Bye.